on Business Incorporated today. United States Vice President Kamala Harris tours Africa next week. Power firms in Ghana reject debt exchange program. And Cape Town in South Africa set to double electricity supply from hydropower. Good afternoon. Welcome to Business Incorporated. I'm Ini John Mekwa. Well, let's delve into business, and we start with market numbers as usual, beginning in Africa. Well, unfortunately for the NGX, is sustaining that bearish sentiment that it closed with yesterday. As intraday, we see that the numbers were 0.04% in the negative. That's the all-share index. South Africa is also down 0.90%, a flip from what it had at this time yesterday. We see EGX is closed today, but closed positive at 2.44%, and Kenya also is closed for now, and it's closed yesterday at 0.05%. We move over to the Middle East now and see United Arab Emirates, the two major markets that are operational on Fridays. We see them in the negative. Abu Dhabi, 0.52% in the negative, and so is Dubai. Dubai almost the same at 0.45%. Meanwhile, Saudi Arabia closed in the positive 0.93%. Qatari also closed at 0.26%, the same number that it had at the close of the previous day. Let's go to Europe now, where it seems the end of that banking crisis is not yet in sight, because we see the banking crisis of the recent weeks resurrecting a controversial debate in the Eurozone. Should the currency bloc have a common deposit insurance to go with its common currency and banking regulations? Well, this is the conversation we'll be having this afternoon with Stephen Bersley, joining us from Deutsche Welle in Berlin. Hi, Stephen. Good afternoon. Well, we do know that the SVB has brought about the issue of the banking stability and all of that, but why is this idea of a common safeguard for Europe? How come we're now talking about it again?
Well, it's most definitely because of this banking crisis that we've seen in recent weeks. Now, in most countries, bank deposits are insured up to a certain point. That means that if you, Joe Schmo, the normal depositor, lose your deposits because a bank has gone belly up, then you will receive them repaid up to a certain extent. Now, those caps are usually between $100,000 and $250,000, depending on the country. Now, all Eurozone members have their own national deposit insurance schemes. The question is, what happens if there's such a major bank failure or a string of bank failures that one country cannot afford, essentially, to backstop all of these deposits without itself getting into trouble? And that's why we expect to see this issue rise again. We know that today, the head of the European Central Bank, Christine Lagarde, is due to talk to European leaders about the health of the financial system in the Eurozone, and she's expected to raise this topic of a common deposit insurance scheme. Now, this is not a new topic. It's been around for a while, and many see it as the final and missing piece of the Eurozone banking union. Keep in mind that the Eurozone already has a common monetary policy. It already has common banking rules. It has a common process to unwind bad banks, and many say that what it's missing now is a common backstop for depositors.
All right, so if this is supposed to be a safeguard, what's the controversy all about?
Well, what's controversial about it is what's controversial about most discussions that happen within the Eurozone when it comes to financial and fiscal policy, and that is the idea of mutualizing risk and liability. That is something that is politically toxic, frankly, for some nations within the Eurozone. We think of Germany, we think of the Netherlands, where they say, why should stronger banks be required to bail out weaker banks that tend to be in other nations? Why should stronger nations financially be required to bail out weaker nations financially? We definitely saw this in the last decade with the Eurozone crisis that was centered around Greece. In that case, Germany in particular saying this is not fair, that we're on the hook essentially for the missteps of another government. And it became a very political topic here. It became something that people were seeing in the headlines all the time. And this is a very fraught time for people to consider potentially mutualizing risk as well, one could say, when you're looking at inflation, when you're looking at the possibility of recession. So that's where the criticism is going to come in here. But in terms of what could actually happen, it may depend on how this banking crisis develops in the coming days ahead, whether this issue becomes one that nations really do have to return to.
Obviously, we're going to get there because it seems that banking crisis is not over yet. But let's move over to the market now. How's that doing today?
Well, we're seeing the European markets are still grappling with what central banks are doing right now. Of course, the Fed raising rates recently, that being something that markets have reacted to in the past days. But they're also trying to suss out where inflation is going. Yesterday, the Bank of England also raising rates. They're trying to suss out where inflation is going versus financial stability. There's still concerns rippling through the European Union as well as the U.S. about whether banks are going to face another crisis in the coming days like they have seen, or whether it will remain quiet after that forced sale of Credit Suisse. A lot of those concerns could come out of the U.S. when it comes to some of those mid-sized banks, such as Federal Republic. Things seem to have gotten better recently, but there is evidence when you look at borrowing by banks and where they're borrowing that suggests that dollars can be tight to come by, hard to come by right now, raising some liquidity issues that could ripple throughout the market. Today, we're seeing the European stocks starting out mostly on the negative side as they weigh some of these issues. And so we'll keep seeing what happens throughout the rest of the day.
You sure do, Stephen. Thank you so much and have a great weekend. All right, let's move to Asia now, where markets were mixed on Friday as investors weigh remarks from the United States Treasury Secretary Janet Yellen, who said that federal emergency actions to back up failed regional banks could be used again if necessary. Well, this conveyed a different message compared to Yellen's comments a day earlier when she told senators that the Treasury was not considering any plans to ensure all U.S. bank deposits without congressional approval. Well, let's look at the numbers now. The numbers looking very red. Red afternoon we have here from Asia. Well, Nikkei 225 in the red, 0.13% at 27,385. Shanghai Composites even worse, 0.64% at 3,265.65. The Hang Seng Index almost the same at 0.67%. The Kospi 0.39%, and in Australia it's also negative 0.19%. What a Red Friday that we do have today. Let's move over to the United States now. Stock futures, they fell as freighted over the state of the global banking system. Once again, futures tied to the Dow Jones Industrial Average. There you have the numbers. Recovered a bit, I see, since I took those numbers. 0.23%, 32,105.25. S&P also green, 0.30%. NASDAQ even looking so good. The tech's doing well in the features of the United States at over 1%. But let's take a little bit of some steps back and see what happened on Thursday's trading with Maria Bird.
The U.S. stock market rallied on Thursday after the announcement by U.S. Federal Reserve Chairman Powell that he would be raising interest rates by just 0.25% before the end of 2023. This was good news for many investors, as they were expecting that he might have been more aggressive with his increase with the recent bank failures. But investors still took a little bit of a dip on Wednesday, but Thursday they rallied back and the Dow Jones was up by 0.2%, the S&P 500 up by 0.3%, and the heavy tech NASDAQ up by nearly 1%. It is clear that many investors are hopeful and they see that there could be brighter future ahead for the U.S. stock market.
All right, Maria, thank you so much. Let's go to global oil space, where prices fell on Friday, extending the previous day's losses on worries about potential oversupply, after United States Energy Secretary Jennifer Granholm said that refilling the country's Strategic Petroleum Reserve, or SPR, may take several years. Brent crude futures slid $2.39 to $73.52 a barrel, while U.S. West Texas Intermediate crude futures dropped $2.40 to $67.56 a barrel. Wow. And there's a sell-off from the view that the United States will not refill oil reserve, even if the price of WTI prices are at $67 to $70 a barrel. Analysts believe that it will be difficult to take advantage of the low price this year. Sales directed by President Joe Biden last year pushed the stockpiles into its lowest level since 1983. The White House has said in October that it would buy back oil for the SPR when prices were at or below $67 to $72 a barrel. On the supportive side, Goldman Sachs says that commodities demand was surging in China, which is the world's biggest oil importer, with oil demand topping 16 million barrels a day The bank forecast Brent would reach $97 a barrel in the second quarter of 2024. Still in the global market, but now metals, gold rose, but remained in a tight range as the metals' longer-term prospects were bright, giving bets for a pause in the United States interest rate hikes. Spot gold was up 0.1% at $1,994.53 per ounce, but it was still locked in a tight $14 range. U.S. gold futures also rose 0.1% to $1,997.90. Prices gained in the last two sessions after the Federal Reserve raised rates by an expected quarter of a percentage point, but signaled it was on the verge of pausing lower rates burnish appeal for the zero-yield bullion. All right, let's go to Ghana now, find out what's happening there. A group of Ghana's independent power producers has rejected a proposal from the government to include $1.4 billion in arrears as part of the nation's external debt restructure, while pushing authorities to honor payments that are supposed to start coming today, Friday. The Independent Power Generators of Ghana, an umbrella association known as IPP, which represents 8 foreign and 1 local power suppliers, is asking the government to meet the payment it owes to 6 of its members or face the possible shutdown of power plants. The groups, according to the group's chief executive officer, well, Ghana external debt reached $29.2 billion in November 2022, compared with $29.4 billion in the previous month. Ghana's external debt was in dollars and updated monthly available from January to November. The data reached an all-time high of $29.4 billion in October 2022. The government's domestic debt exchange program closed on Friday, the 10th of February 2023, with over 80% participation of eligible bonds. Let's take a breather. When we come back, we do have more stories waiting for you, especially from the African side. This is Business Incorporated on Channels Television. Welcome back. Still watching Business Incorporated here on Channels Television. The United States is determined that all sides committed war crimes during the conflict in northern Ethiopia that killed tens of thousands. Well, the Vice President, Kamala Harris, will become the latest top official to visit Africa, and that'll be next week in a couple of days, with a stop scheduled in Ghana, Tanzania, and Zambia. She's following Treasury Secretary Janet Yellen and Secretary of State Antony Blinken, who had both been in the region recently at a December summit with the continent's leaders. Biden pledged $55 billion support package for Africa. As at November 2022, Africa accounted for less than 2% of total U.S. merchandise exports and imports. The overall value of U.S. exports to the continent fell $32.9 billion in 2001 to $26.7 billion. And South Africa has become the largest U.S. trading partner on the continent. Its export to the U.S. rose to $15.7 billion in 2021. That's the highest for at least 10 years. All right, now let's go to Ethiopia, as we see there's been some development in that region, as we see that the issue of committed war crimes, and the United States is determined that everyone involved would pay for it. Meanwhile, we see that Ethiopia's Prime Minister Abiy Ahmed has established an interim administration for the Horn of Africa's country, northern region of Tigray, a key step in the implementation of a peace plan to end war there. What does all this mean for the economy, especially? We have Matt Kindiger, he's a practice leader with SSA Frontier View, joining us from London. Hi, Matt. Good afternoon. Good to have you on the show this afternoon.
Hi, good afternoon. Thanks for having me on the program today.
Great. So what does this formation of a government in Tigray mean for the prospect of lasting peace in Ethiopia?
Yeah, so in our view, it is generally a positive development, and it does mean that there is likely to be much more constructive engagement between the federal government and the Tigrayan government over the next couple of months. And it's also worth remembering that this development comes in parallel with the Ethiopian Federal Parliament officially removing the TPLF from a list of terrorist organizations. So again, this will engender some goodwill between both sides, and it is overall part of a sign that we're seeing some more positive development for lasting peace in the country. However, I would emphasize that the peace agreement in Ethiopia, especially between the federal government and the Tigrayans, remains quite fragile. And this is because the presence of Eritrean troops in Ethiopia, especially in Tigray, remains fairly unaddressed, and this could be a source of tensions between Tigray and the Eritreans. We also have the role of other regions' armed forces, especially from Amhara and Oromia. They could result in some sort of tensions between Tigray and the rest of the country. So there are still some uncertainties there, but I would say there is a very strong desire by both sides because of the impacts of the civil conflict over the last couple of years on the central government's economy, but also the humanitarian crisis that we're seeing in the north of the country. So our view is that there's probably going to be slow progress, but there is still some risk to the outlook for the peace agreement.
So we do know that Africa is getting a lot of attention from the United States, but let's look at one of the past visits. Will Blinken's visit to Addis Ababa improve chances of Ethiopia being readmitted, to the U.S. AGOA trade program? Do you think?
Yeah, so I mean, Blinken's visit was very important because Ethiopia really wants to be readmitted to the AGOA trade program. It provides Ethiopia and other African countries with preferential access to the US market, which is massive. So again, I think it's a positive development because it shows that the Biden administration and Ethiopia want to reestablish improved ties. So traditionally, Ethiopia was a relatively strong US ally, and it was quite enthusiastic about Ethiopia's, well, the US was quite enthusiastic about Ethiopia's development. So there is, it's a positive sign, but I think there's a lot more work that needs to be done. Blinken's statement that he believed that war crimes were committed on both sides will likely displease the Ethiopian government. It's already expressed some displeasure at this. So our view is that there's a lot more work to be done, and there should not be an expectation that the Ethiopian economy will be readmitted to AGOA. And this does mean that sort of exports from the economy, sentiment from investors into the economy will be slightly muted for the next couple of months or maybe even years.
So how do you think all of this will affect the currency on one hand, the economy, looking at the bigger picture?
Yeah, so very broadly looking at the economy, there's no question about it that the Ethiopian economy is under pressure. The economy will continue to grow over the next couple of years, in our view. It's going to grow by about 4%, maybe 4.5% in 2023 and 2024. This sounds quite good by global standards. There are certain industries that are doing quite well. Infrastructure investment, agriculture production is also improving in parts of the country that are not affected by the civil conflict. And there's also gold mining. But really, 4% growth is some of Ethiopia's worst performance since at least the early 2000s. So by Ethiopian standards, it's not great. We are seeing very weak investor sentiment. And there are rather extreme currency shortages in the country. So looking at the currency, we are expecting the birr to gradually lose value over the next year or so. The central bank has imposed very harsh currency access restrictions. Only essential products, medicines, for example, inputs into manufacturing are permitted to be imported into the country. And for the foreseeable future, we believe this will remain the status quo. So this is why it's so important that relations between Ethiopia and the US improve, that it's readmitted to AGOA, and that there is lasting peace in the north of the country, because then investors will once again want to revisit Ethiopia. Until then, the currency will remain under pressure, in our view.
Yeah, unfortunately, Matt. But thank you so much for giving us the picture of what's going on in Ethiopia there, especially Tigray. Matt Kiniga is a practice leader with SSA Front of You. Thank you so much.
Thanks.
All right, let's get in some stories before we go. Cape Town, that's in South Africa, is considering doubling its electricity supplies from hydropower to almost 400 megawatts as South Africa's second biggest city tries to reduce the impact of power outages imposed by the national utility. The municipality is conducting a study to expand its 180 megawatt St. Bras hydropower plant and is in talks of a project that would supply electricity from potential sites outside the city. And Cape Town's executive director and climate change says he's in talks and ensures that this would come to be. Well, I guess that's the much we can take on the program today. Thank you so much for being a part of Business Incorporated. I'm John Meko. Have a great weekend. I'll see you next week.